Welcome, good afternoon. Thank you so much for virtually joining us today. We appreciate your presence. While I appreciate Zoom and how convenient it is and how it allows our out-of-town friends to join us, I can't wait until we can meet in person again. So aiming for that for our spring briefing, which I really look forward to. A slightly different format this time than our normal webinars that we've had as far as the questions go. Due to regulatory compliance, we have to turn off the question portion of Zoom. So please direct all your questions to me at my email address. It's on the screen right now, djarvis@hightoweradvisors.com. I also emailed everybody this morning preemptively to just see if you had any questions. So please send those to me and then I'll facilitate a question and answer session at the end. Before we get started, I thought it would be a good idea to introduce the team. I think it's always nice to put a face to a name. And for those of you who haven't seen us in a while, you can have a quick reminder of what we actually look like. So from left to right, Ned Evans, Mike McQueen, Adam Thurgood, Sheila Delutri, our newest team members, CJ Neff, Debbie Kay, Shelby Sutter, Raina Penalova, and last but not least, Hugh Anderson and myself, Dana Jarvis. So again, thank you all for being here. We really appreciate you taking the time to join us. Without further ado, I'll turn it over to Adam to go ahead and get the presentation started.
All right, well, thanks, Dana. Like she said, I can't wait to see everybody in a big group setting at some point in the future. Maybe we should have our client briefings at T-Mobile or Allegiant Stadium because there are plenty of crowds there, but for some reason it's difficult to get people together outside of sporting events. So we look forward to the future. Now, we titled this presentation, "The Times They Are A-Changing," and I think you'll see the themes play through as we go about the discussion. But really this theme came up as I was driving to Park City last month. And I love classic rock, not as much as Sheila. She's a classic rock nut, perhaps the most nutty of all. But I've heard Bob Dylan's song, "The Times Are Changing," hundreds, if not thousands and thousands of times. And I can sing along to it and you know, it feels totally natural, but I haven't really thought about the lyrics in quite some time. And for some reason on that drive up to Park City, every single verse of the song really resonated with me. And I brought it back and shared the experience with the team because that song was written in a time of great social movements. You had, you know, freedom of expression going on in the 60s, civil rights going on. We're in the middle of Vietnam. There were international affairs at a very high level. Certainly generational tensions and political discord was extremely elevated. And as I heard each one of those verses, I kept thinking, wow, that is so relatable to what's happening today. We certainly are seeing social movements. International affairs may not be tactile wars, but they certainly are elevated in a lot of different ways. Political discord, we all know how that's going these days. And then of course, generational tensions are epitomized by the term "okay boomer." So we're seeing a lot of change. And when you have a lot of change going on, you have to digest it and understand how that change could impact you. And really when you're faced with change, you have two choices. One is to stick your head in the sand and hope that the tide doesn't kill you when it comes in. The better choice is to try and take advantage of the opportunity that change presents and ride the wave of where that change is taking you. So one of our favorite quotes that we love to talk through is one by Charles Darwin. It's often misunderstood, but it basically says it's not the strongest of the species that survive, nor the most intelligent, but the one most responsive to change. And so our jobs as investment managers and wealth managers are to have our antennas up for what's changing and then figure out how can we adapt and be responsive to that change. Now, when we look at what's going on in the global macroeconomic environment today, we see a couple of big changes that potentially have structural impact going forward. One is labor dynamics, which we'll dive into. globalization or deglobalization issues that we're seeing today. And then the third is fiscal policy and perhaps how that's morphing into something more than just traditional fiscal policy. So let's start with labor dynamics. I'm sure that if I was in a room full of people and I asked how many people have seen a help wanted sign on just about every business they've walked into, almost every single person would raise their hand. Whether it's Chipotle, Home Depot, a gas station, there are help wanted signs everywhere. We're in a very unique environment right now where we have more job openings than we have workers that are actively searching for work. And that is somewhat abnormal. Now we saw it a bit in 2018, but the unemployment rate was much lower. Today we're sitting at somewhere around 8 million or so unemployed persons and upwards of 10.5 to 11 million open jobs. Now, why is that happening? That's a very strange environment. If you were an unemployed person, why wouldn't you just go out and get a job? Well, there are certain things that are and drivers that are causing this to play out. So let's talk through each one of those one by one. The first is that the enhanced unemployment benefits that we put in place really disincentivized a certain subset of the population from going back to work. There were people on the lower end of the work spectrum making, minimum wage or slightly above minimum wage that suddenly were getting paid more than they would have to go to work via enhanced unemployment benefits. Now those rolled off in September a couple months ago, and we're starting to see some more activity for those types of people coming back in and searching for work. They may have been able to save up some money to enjoy life a bit longer, but we think that temporary vacation is probably going to work its way out over time. Unfortunately, I don't think that this is the main driver of what's going on. It's certainly a contributory factor, but it's not the main driver. Another big driver is career change. COVID was a shock to everybody. It made everyone take a step back and think about what they wanted out of life. And a lot of people decided, I want to change my career. I want to do something different. I want to invest in myself, start my own business, or I want to go and get some technical education, or I want to go back to the university and complete my degree and change my career. Those people are probably not coming back to the types of jobs they were in before. And so it's left an empty void for those workers that have left for someone else to come in and fill those positions. Another is burnout. Societally, we've kind of adopted a new mentality when it comes to mental health and working through those types of issues. And we're seeing data now that is supportive of people, especially couples, being more willing to allow their spouse, one of the spouses, to take some time off and refresh and regenerate and do some things that they've always wanted to do in life. And so that's a big change from what we've seen over the past, let's say, 50 years, when women really started to enter the workforce and we had dual income families. We're now seeing somewhat of a reversal of that, albeit temporarily, but that still pulls people away from available employment. And then the fourth and really a huge issue is early retirement. We were already facing a wall of baby boomers that were set to retire. We were looking at around 10,000 baby boomers that would turn 65 each day. And some of those may not have been slated to retire at 65, maybe it was 68, 69. But what happened post-COVID is asset prices went up so substantially that it allowed some people to retire early. And those people are not coming back to the labor force either, unless there's some catastrophe and they have to come back to make ends meet. So the labor market is changed. It's definitely changed. And these issues could be with us for quite some time. And what you have at the end of the day, when you have so many open positions and not enough people to fill those positions, businesses are faced with a simple problem, and that is try and do without or raise wages so that we can entice people to come back to work. And that's really what we've been seeing. Wage growth has started to accelerate. We're at the highest level since about 2007, roughly 4.25% average hourly wage growth. And it looks like those numbers could be headed higher until some of these labor issues subside. Now, the second issue that we talked about is supply chains and globalization. I don't know how many people had ever really thought about supply chains before COVID, but now it seems like at any cocktail party, event, game, restaurant, you'll overhear somebody talking about the supply chain issues. So our lexicon has been updated across the population to include this term. And the supply chain issues are a big deal because they relate to not only the normal goods and services that we think of, but also the inputs to those goods and services. Just take, for example, what's happening outside of the ports in LA. We now have, this is a bit dated, I think it's closer to 100 ships docked off of the port in LA, Long Beach, waiting to have their cargo unloaded. And that cargo can be incredibly important as an input to some other good or service that is waiting to be completed and shipped out. So we have this massive bottleneck. Some of that is labor related. Some of that is simply too much demand to be able to deal with the capacity that we have in place. Some of that is regional. I actually saw an ad from Texas saying our ports have much lower wait times, so you might as well just sail your ship around the continent and unload at Texas. That's highly inefficient in normal times, but maybe necessary going forward. So these supply chain issues will take time to work out. Now, why are we facing this? Well, over the past 30 or 40 years, we've outsourced a lot of our production to more efficient parts of the world in terms of the cost. So it takes a lot more to put the pieces together when they're being sourced from Asia and Europe and all sorts of different places. Now, we've also been hearing a lot about the chip shortage. Why all of a sudden do we have this chip shortage? Well, every single day that goes by, we use more and more and more semiconductors in our everyday lives. Just take a look at what the average car has today, 1,400 semiconductors, ranging from things that help its safety and powertrain and electrical to some of the infotainment. If you don't have chips, you cannot make a car in today's world. Now, some of us long for the old days when we had very simple cars, but those are more collector's items now. People want that luxury of all the different benefits that come with a technology-driven car. And if you think about what's happening with 5G, which means we're going to have chips in everything from our toaster oven to our refrigerator that will be connected to our Alexa device, the chip shortage is real and it could persist for quite some time. Now, we would have to talk through the US-China relationship if we're going to put any sort of bookend on this supply chain issue. There's a lot to digest here. We could probably spend an entire hour talking about the supply chain issues related to China and the US, but there are three main components that we want to discuss today. And the first is that China no longer is a cheap source of labor. China's become a rich country. And so all these places, all these companies that have gone over to China to have their products and services built are now having to pay more and more and more as people in China demand higher and higher wages. So the supply chain will probably start to regionalize or at least start to move away from China simply because it's no longer the low-cost producer. Now, if it comes home, we certainly have higher wages than what we see in Asia, and that would be an inflationary pressure. It would help with the robustness of our supply chain, but it would come at a cost. One of the other big issues is the technological Cold War. When President Trump decided that he was going to squash Huawei as a participant in the 5G market, that sent shockwaves through the system. And the Biden administration has been no more lenient on China. In fact, they've stated that slowing down the Chinese technological advancement is one of their priorities. So we're in a strange place where we're not in a tactile war, but we certainly are in somewhat of a Cold War when it comes to technology. And as a result, that might mean that companies are less willing to operate in that region and want to bring more of their supply chain closer to home. And then finally, and I think this is a huge one going forward, is we are moving from a just-in-time system, which was really popularized by the Japanese, which created enormous business efficiencies. It allowed businesses to have as little supply of goods and services that they needed, or goods on hand that they needed for creating their final product, and that increased margins, but it comes at a dramatic cost. And we've seen that over the past year. If you can't get the pieces of inventory that you need in order to build your final product, that's a huge problem because you can't create sales. And so in a sense similar to how people have been hoarding materials at their homes, like toilet paper or food, we think that businesses will decide to sacrifice some efficiency for robustness by going to a just-in-case inventory system rather than a just-in-time inventory system. And these changes in the supply chain could have significant implications going forward on the price of goods that we will have to pay. And of course, we need to talk about DC, which actually stands for Drama and Comedy, not the District of Columbia. I'm sure everyone can appreciate the hilarity in this cartoon. It's a mess. It's a total mess, and it's getting to be more of a mess. But we're not here to take sides or to make this a political discussion. What we're here to do is to think through how it might impact the change that we're digesting today. So we're going to look at this in two different ways. One is what's going on now, which is changing every day with some of the spending bills, and then also the bigger picture long-term issues. So we know that both sides of the aisle in Congress have agreed in terms to a $1 trillion infrastructure deal, but it's being held up by the progressive side of the Democratic Party because they also want to get a 1.75 trillion or more spending bill in place in addition to that. And that bill has been trimmed down from about 3.5 trillion down to 1.75 trillion. It's being paid for through a variety of different taxes. This is just an example of where some of those dollars are coming from. I don't want to spend too much time digging into each one, but there are some new items that we haven't seen before, like wealth surtaxes, taxes on buybacks of shares, corporate minimum taxes, and so on and so forth. We don't know where the final bill will end up, but what we are fairly confident in is that spending is set to increase pretty dramatically. You know, a $1 trillion bill is now kind of commonplace, and before it was unheard of to have such large spending bills. Go back to 2008 in October when the economy was going to hell in a handbasket pretty quickly. The first TARP attempt to pass failed, and that bill was only 700 billion. So today we're throwing around trillions like they used to be billions. Trillion is such a massive number. I'm sure you've heard me talk about this in the past, but it's so hard to quantify for a human being because the number is just so large. The easiest way for me to understand it is by thinking of it in terms of time. If you go back 1 million seconds, you're about 11 days in the past. If you go back 1 billion seconds, you're in about 1989. And if you go back 1 trillion seconds, you are somewhere in the neighborhood of 30,000 BC. So trillions are such massive numbers, and we've kind of normalized spending at these levels, which is a little bizarre. And as a result, projected debt levels are going higher. Now, some of this is the spending that we're seeing today, but a lot of this is actually sins of our past. It's being driven by unfunded Medicare and Social Security obligations, and those are expected to increase as baby boomers hit the age when they start to draw on those services. And this is a bit of a concern because once you get to a certain level of debt to GDP, the odds are in favor of some sort of a structural problem with the ability to repay that debt. There's been I can't remember the exact name of the author, it's just slipped my mind, but there was a very highly regarded economist that looked back over the past 200 years and found that 52 nations had debt to GDP levels above 130%, and 51 of those defaulted on that debt. Japan is the only one that did not default. Now, when I say default, that doesn't mean the traditional term of default, which is they just don't pay it back. Some of those countries restructured, and a lot of them actually used inflation as a way to erode the nominal debt to GDP. We think that's the likely path forward. Now, just to appease both sides of the aisle here, spending historically has been a mixed bag. It's not always one party like the other party thinks that's the spender. It's dependent on really what's happening in the global economic landscape. But really over the past 20 years, it doesn't matter who's been in power, those people in power have spent. And we think that's a theme going forward. As populism rises, as the parties try to appease to those people in the base, we think that additional reoccurring stimulus is likely. And perhaps more important than that, we expect to see more government guaranteed loan programs. This is a big deal because it's also a way for the fiscal side of things, which is Washington in terms of Congress and the presidency, getting involved in monetary policy. When we look back at COVID, one of the most impactful things that I think we'll take from this 10 or 20 years down the road was that the PPP program was largely a success. It injected money into the hands of businesses, but it opened up the door for government guaranteed loan programs to be more commonplace. And why is this a big deal? Well, because banks have not been readily willing to lend a lot of money over the past decade since the financial crisis because they're worried about the risk. And if the government backs that risk, then money can start to flow more aggressively through the system, and that is also inflationary. So when we look at this inflationary balancing act that we see today, over the past 30 years, we've had massive headwinds against inflation. Demographics has been a big one, globalization, that efficiency that we talked about in the supply chain and driving down cost. And then technology has advanced so much, and technology is deflationary by nature. But today we're seeing counterbalancing forces that may end up being more powerful. If we go from globalization to regionalization, that's a big deal. If these labor dynamics continue to stick, that's going to be a big deal. And if fiscal policy starts to take the form of excessive spending and influencing monetary policy, that's also a very big deal. So there are really two types of inflation that we have to think through. And we'll get to that in just a second, but I wanted to show you how inflation has trended over the decades. In the 70s, we had enormously high inflation. If you talk to anybody that's 60 years or older, they'll tell you about their first mortgage being at 15 or 17%, which the younger generations today can't even fathom. But inflation has been coming down and down and down over time. And now we're into the 2020s, and inflation's back on the rise. In fact, I found it quite fascinating that the Social Security adjustment for next year is 5.6%. So Social Security recipients will get 5.6% more than they got this year as a result of elevated levels of inflation. So let's talk about the two types of inflation. The first is first order inflation. That's where some type of a shock causes prices to go up. As a result, demand goes down, and eventually they have to lower prices to get demand to come back up. And there's a term that is commonplace that says the cure for higher prices is higher prices. So the Fed's not really worried about first order inflation. It takes care of itself. What they worry about is second order inflation. And that's when some external force keeps prices elevated, like a supply chain issue. And it causes people to say, hey, boss, I need higher wages because I can't afford the things that I am used to. So the boss gives them the wage increase. That puts pressure on the margins of the business. Most times the business will protect itself and raise prices, which then causes the real wages or the purchasing power of those workers to go down. And as a result, they go back to the boss and say, hey, I need another wage increase. And this is a reinforcing cycle that can be hard to get out of. This is what we saw in the 1970s. So that's the type of inflation that the Fed is worried about. And today we're starting to see the early signs of second order inflation. Now, if it materializes, the Fed is really between a rock and a hard place. And the reason is that in the past, the way that you combat inflation is you raise rates. But today, with asset prices at record levels as a result of low interest rates and debt levels at such high levels, it's going to be difficult to raise rates to a level that would be sufficient enough to take down inflation without really hurting asset prices and crushing the economy. So if we do see second order inflation take hold, the Fed is going to be faced with a very difficult decision. And that is, do I raise rates and hurt the economy, or do I let inflation run hot to help erode that nominal debt to GDP level, which we want to have happen. I'm speaking from the Fed, not from me personally. But at the same time, if we do that, then we potentially crush the purchasing power of our currency relative to goods and services. So the Fed is on a very bouncy tightrope at the moment. They actually just came out a couple of hours ago and announced that they're going to be tapering their bond purchases. Since the start of COVID, the Fed has been purchasing about $120 billion of bonds per month in treasuries and mortgage-backed securities. And they're going to scale that back by 15 billion per month until it eventually phases out in the early summer of next year. And we'll see how the market responds to this. That means that at some point, the market's going to need to buy that 120 billion that the Fed is buying right now. And normally the market demands higher interest rates in order to do so. So the Fed is trying to bifurcate its strategy and go with tapering first, but keep interest rate hikes way out on the horizon. They've said 2023 is when they're looking at it. The market is predicting that they will have to move in 2022. And that's really when the rubber could hit the road with how the Fed responds. So we see a lot of potential change in a structural way, not necessarily, it's not going to be that way all the time. You can have cyclical cycles inside of a big structural trend, but we see inflation as a structural force starting to gain a foothold, and it seems to be gaining a stronger and stronger foothold every day as we move forward. And that's a big deal, and it's something that we've spent a lot of time thinking through. So I'm going to turn the tide over now to Mike, and he's going to talk through how we are positioning and strategizing around inflation. But before I do that, let me remind you once again, if you have questions, send them to djarvis at Hightower Advisors, and we'll get to those in the end. So let me bring Mike on and we'll go from there.
All right, thank you, Adam. Okay, that was wonderful. Now, my job is going to be to lay out some of the strategies that we believe are important for investing in what we believe is this new inflationary environment. And the first one, you may have already been aware of it, is to invest in commodities. Commodities tend to be directly tied to inflation pressures. If you've not been familiar with this strategy, let me define what commodities are. Literally, everything we consume in the physical world comes from some sort of raw material, right? These base level raw materials are what we mean when we refer to commodities. Commodities are categorized into a few groups like metals, agricultural products, and energy. And when we think about our daily living, commodities play a central role. Lumber and copper are important components of our home. Steel and aluminum are important raw materials in the cars we drive. And grains and meats are important components of many diets. And probably all of us wear some sort of clothing made of cotton every day. So the bottom line is commodities are important, especially when we face periods where demand is elevated or when supply is constrained. All right. So the supply of, and in fact, the demand for commodities is in constant flux, as you can see here, cycling between excess supply and excess demand. During periods where demand is weak relative to supply, prices tend to fall and vice versa. However, supply and demand cycles tend to be long-term. Over the past 200 years, we've seen several major cycles in the commodity pricing market. If you look here, for example, at the height of the Cold War, when globalization was just a fraction of what it is today, commodity prices had escalated at an annual 10-year compounded growth rate of 10% a year, where over the last 10 years, we've seen commodity prices fall by an average of 6% a year, fall by 6% annually. So we believe the forces are aligning for another period where commodity price growth could happen, and it could last for a couple of decades. So when you view it in relationship to stocks, commodities look quite cheap. With stock valuations at or near their all-time highs on just about any measure you want to use, it's not really a stretch to believe that commodities might outperform stocks over the next decade. And when you compare it to bonds and historically low interest rates and the risk of inflation, commodities make even more sense as part of a broadly diversified portfolio. Right. So during periods of rising inflation, commodities and precious metals have been the best performers. While commodities have only returned a little over 4% annually since 1970, they produced returns in excess of 14% during periods of inflation. And gold has had pretty similar results. And While stocks have been the best overall long-term performer, during periods of inflation, they've failed to keep up with commodities and precious metals, and bonds have performed quite poorly during inflationary times. So we've long been believers that gold offers tremendous diversification benefits in a portfolio. You've seen it in your portfolio. We've talked about it with many of you. It tends to perform well when fear is present in the system, which helps offset portfolio volatility. And while gold may not give you a dividend check or an interest check like stocks and bonds, the average return of gold over that period of time has been very healthy. In fact, since 2000, gold has had positive returns in 16 of the last 22 years, with an average annual return of 9.6%. That's pretty good return for holding an asset that helps reduce portfolio risk. Normally, something you look as a hedge in your portfolio wouldn't give you that kind of return. So this is rather interesting to note. And you might be wondering what we think the next couple of decades might look like for gold. As Adam outlined above, we think the macroeconomic forces are very much in gold's favor. So one of the things we find interesting is that in a world where these central banks have been printing money like crazy, they've also at the same time been building up their gold reserves. The developed market central banks have moved from being strong net sellers of gold back to being buyers of gold in the last few years, while the rest of the world has also actually been busy buying up gold supplies to shore up their reserves. And we think this trend is going to continue for a number of years. So our friends at Incrementum have done some great work on the gold market, and they believe, just like us, that the probabilities favor high gold prices. While anything can happen, this company actually believes that there's a greater than 90% chance that we'll see higher gold prices by 2030. And they believe that there's a probability weighted average price for gold of nearly $5,000 an ounce that could be possible. Very interesting. So another asset that we've presented on several times over the last year is Bitcoin, or what some like to refer to as digital gold. And yes, while Bitcoin is a very volatile asset, we believe it can add tremendous benefits to your portfolio if used in the right, if it's sized appropriately in your portfolio, let's put it that way. And Bitcoin shares many of the properties that make gold valuable, such as its scarcity and its durability, believe it or not, with the added benefit of being more portable and more divisible than gold. So as a result of the growth that we've seen in this area, big financial institutions have been starting to take notice after having scoffed at it for a long time. In the past year, we've actually seen public companies put Bitcoin on their balance sheets. Companies like Fidelity have begun accepting Bitcoin as collateral for some loans. Visa is laying out a roadmap for their cryptocurrency adoption within their system. And one of the oldest banks in America, actually, the Bank of New York Mellon, has begun to custody or hold Bitcoin for its clients. These are enormous endorsements for both Bitcoin and the digital asset space, and we believe that investors need to pay attention to these signs. Now, in terms of total market capitalization, Bitcoin remains relatively small at around $1 trillion. However, it's growing quickly. Bitcoin is now worth about 10% of the total gold market. In a world where central banks are literally tripping over themselves to debase their currencies, we think both gold and Bitcoin can increase in value, and both can play an important role in a properly diversified portfolio and a risk-managed portfolio, particularly in inflationary times. Okay, another movement gaining momentum is something called ESG investing, which stands for environmental, social, and governance. The environmental factors look at the conservation of the natural world. Social factors examine the treatment of people both inside and outside of a company. And governance factors consider how a company is run. Many of the world's largest asset managers, such as BlackRock and Vanguard, have begun to use their influence to push these ESG policies forward. And this presents both opportunities and risks for investors and for society. As a result, we've studied the way the market is trending, and we found a few ways to integrate this thesis into our portfolios. Actually, one of the more interesting approaches to ESG is that we've been focused on is focused itself on freedom. Freedom as a way to filter international investments. As Americans, we can appreciate the benefits that freedom provides, and investing in countries that rank higher in terms of their civil liberties, their political processes, their economic systems makes a lot of sense to us. Countries with greater civil liberties can be more creative and entrepreneurial, for example. Countries with greater political freedom are less at risk to authoritarian leaders and currency issues, while economic freedoms such as property rights are highly important concepts to investors. Now, as the world's second largest economy, China is still a sensible place to have some exposure. However, we have trimmed our position in that, and we've added to countries with better freedom scores. Okay. Now, while the debate over energy policy is very political, we force ourselves to step back from the politics and we think through the implications of these policies. As concerned citizens, we're fully on board with the notion of a clean energy grid. However, the path to getting there is filled with some risks that need to be carefully managed. As we've studied this, we believe there's a significant opportunity in certain areas of the energy market where political divides are actually receding a bit. Okay, the most important part of our energy grid is something called baseload power. This is the power that works regardless of the wind, the sun, or the weather. Solar panels and wind the turbines, they're great when the weather's right, but they can be disastrous if that's the source of baseload power. We actually saw this play out in Texas this past winter, right? So the traditional forms of baseload power have come from the old familiar names, coal, natural gas, and nuclear power. But coal and natural gas have really fallen out of favor due to their carbon emissions, especially coal. However, one form of baseload power is now seeing support from both sides of the aisle, and it's nuclear. The Biden administration is the first Democratic administration to be pro-nuclear, and we believe that's a pretty big deal. Nuclear power is by far the most efficient form of energy we can create. For example, wind and solar produce about 3 units of energy output per unit of energy required to get that output. With nuclear power, that number is about 100 to 1. So if the politics align, big if, we could see a resurgence of nuclear power with present day technology, not the 1960s technology that is currently used in most operating plants. Now, nuclear reactors rely on uranium to operate. Uranium is a niche commodity that receives very little attention. You probably haven't paid any attention to it since science class. However, its importance to the green energy movement could be very, very significant. As it stands today, uranium is projected to be in a major supply deficit in the coming years. This supply deficit could be exacerbated by this globally renewed effort to use more nuclear power. We've positioned for such an event, and we have exposure to uranium in almost all of our portfolios. And just today, while we're finishing up this presentation, we saw that China announced that they're going to build 150 new reactors in the next 10 years, more than the rest of the world has built in the past 35 years. They're going to spend $440 billion on this. So in addition to the nuclear theme, we believe there's still an opportunity in the traditional energy names. As we've moved towards incentivizing green energy power generation, we've also made it more difficult to invest in new fossil fuel production. This leaves us in a potentially tricky situation where renewable energy is not yet at capacity to service our energy needs, but we've impeded the ability of the fossil fuel companies to fill the gap. As a result, we could face rising risks of power generation and higher fossil fuel prices. About 18 months ago, we saw oil futures trade at a negative $37 a barrel briefly because of a strange supply-demand mismatch. We could end up seeing the exact opposite situation ahead of us. So yeah, we believe having an overweight position in traditional energy stocks is a prudent move at this point in the transition cycle. And as you can see from the information we presented, we believe we're at risk of the phrase that we use here all the time, sustained inflationary pressures. That's the takeaway from this today, sustained inflationary pressures, the effects of which could impact portfolios for many years to come. So in this environment, we believe it's important to have broad diversification to take advantage of these special situations that we've just discussed when they arise. Now, this is a little different than the typical stock and bond portfolio. So while change can be uncomfortable, it doesn't have to be scary if you prepared for it and positioned yourself for that change. Okay, we're going to get ready for the Q&A session, but this is yet another request because of our compliance overlords to email your questions to Dana Jarvis at djarvis@Hightower Advisors so that she can manage the process of getting all the questions out and answered. But we will leave you with this image in a minute and the thought the next 2 months tend to be generally friendly to markets, no guarantees. So let us become one of the first people, aside from department stores, to wish you a very merry holiday season, and note that forecasters are predicting one of the strongest holiday shopping seasons in years. That combined with what's stuck out in the ports means you better get your shopping done early.
Yeah.
Okay, I'm turning it back over to Adam and Dana to get through the questions.
We have 0 questions at this point. Guys, come on. I know you're curious. Give us some
I'll throw
questions.
out a question to Mike, and he can throw the same one back to me. When you sit in bed thinking about the economic situation and where we're potentially headed, what is the one factor that really causes you to lose the most sleep?
Well, I think, we've talked about the big cyclical force here, which is inflation. And that's sort of if I had to put it in terms of a medical condition, I'd call it a chronic condition, right? It's something that we're going to probably have to learn to live with. But I don't so much lose sleep over things that are long-term events. I lose sleep over things that are more potentially short-term and unexpected, and that could have a more significant effect. Sort of if I slipped and fell, or like I had a few years ago, a ruptured appendix. And I look at the economic equivalent of a ruptured appendix is probably the Fed doing something unexpected and making an unforced error. I think that's where I would lose sleep. It doesn't look like they're about to do that because they were very thorough today in telegraphing their intentions. And I can assure you that every word of that statement they released today has been scrutinized many times by many big investors. But I worry about that as much as I worry about anything else in the short term.
Yeah, policy error is really the big risk. When I'm a traditional value-minded investor, and I like to look at things like valuations. And when we look at markets today, they're at record valuations in everything but interest rates. And so part of me says, well, this just is silly and it has to reverse. But if you really take a step back and think about where the incremental spending comes from in society, it comes from wealthy people that have assets that appreciate, and then they feel more confident spending money. So the Fed, whether they like it or not, has created an environment where asset prices are a national security risk. If they go down too much, then the whole system, is at risk of having a severe recession. So while I am concerned about valuations, and we don't want to be silly and push for things that make no sense, I also think that the Fed's going to have a shorter leash on whether or not on whether they allow valuations to fall. Now, I say allow in very tongue-in-cheek terms, because while the Fed has had tremendous control over markets over the past 20 years, there could come a point where the market loses confidence in the Fed. And I think that's what keeps me up most at night is that near? I don't think it's near yet. In fact, it seems like the market has full confidence in the Fed. But if and when that were to occur, then that's when I start to get a little more nervous. Now, on the flip side, what keeps me most excited is just the massive amount of change that is going on in the technological world that could have really profound impacts on how we do things. Like you talked about Bitcoin, and I think that the blockchain technologies that are being developed today have just a tremendous potential to enhance the way that we do business, from everything from title insurance to property records to the way that stocks and bonds are traded. It's a whole new world, very, very fascinating, and something that I spend a lot of my free time on because I've never seen anything like it before.
I would say that I share those views. And I think back to, because I've been doing this for so long, maybe 25 years ago or so, when the internet was really getting started, and people were just scoffing at Jeff Bezos for this silly idea he had to sell things online, and who would ever trust that to be a reliable way to do commerce. Lesson learned, right? So this time, one of the most dangerous phrases in the investment business is that this time it's different. I think that lessons learned from the past can be applied here. Scoff at new technologies at your own risk. Learn as much as you can, make your own decisions, but don't in general dismiss them as something that we've made it this far without and we don't need. The world is a-changing, as our slogan started this presentation, and Bitcoin and cryptocurrencies are absolutely part of that. And they are an exciting thing to consider.
So on that note, the questions are rolling in now. on a crypto note, what do you see happening with regulation on crypto? And second part of that question, do we have plans to have greater exposure in the crypto market in our portfolios?
Sure. The regulatory framework is quite interesting. We have a tendency as US citizens to think in US terms. And so we have to keep that in mind when we're talking about regulation, because it's only the US regulation that would apply here unless there's some sort of a global pact on regulation. And the way that we've seen regulation progressing in the US with respect to cryptocurrencies is twofold. There are things called stable coins, which you can think of sort of like money market funds, and they're completely unregulated right now, and they pose risks to both the crypto market and the financial system because they've grown in size so much. And just in the last couple of days, we've seen some potential frameworks for regulations around stable coins to treat them more and more like what you'd see out of a regulated bank. And then from the SEC's perspective, which looks at securities, they've been fairly clear that they believe most cryptocurrencies are securities, with the exception of Bitcoin and potentially a few others. And so that could have pretty significant implications in whether or not those securities could be purchased by US citizens if they don't go through the regulatory hoops in order to be registered as securities. Now, again, these are US regulations, and Bitcoin especially is a global phenomenon that can operate outside of the regulatory framework within a certain country. Think back to 5, 6, 7 weeks ago, China banned Bitcoin mining, and everyone thought that was going to be the end of the world. Those Bitcoin miners shut down, they transferred to other parts of the world, they started back up, and Bitcoin really continued to move on without too much of a problem. Its hash rate, which is a term that looks at how much computing power was in the network, fell for a period of time, but it came right back on. So I think that was a lesson to the rest of the world that if you try and do something too severe, you may end up seeing that opportunity move somewhere else. And what's I find most fascinating is we have members of Congress that are very pro-Bitcoin now. The senator from Wyoming is very pro-Bitcoin. We have several different people in the House that are very pro-Bitcoin, and they're pushing to keep US regulators from making a mistake that would make the US uncompetitive in a space that is going to grow in importance globally over the next decade or two. In terms of how we own it in our portfolio, the regulators are still, I'd say, behind the curve on this. There are only a few securities that exist today where you can have exposure to the pure cryptocurrencies. We have exposure through a couple of different names that we can talk to you individually about, but because we're recording this for people that would like to watch it in the future, we can't mention any specific names on a recorded webinar or a webinar in general. So reach out to us if you have questions about individual names in the portfolio that have exposure to Bitcoin.
Perfect. Thank you. What is an appropriate portion of crypto or gold that you should hold, or is there an appropriate portion of crypto and gold?
Yeah, I've always thought of this in terms of probabilities of a bad outcome. In my mind, if you look back at prior monetary debasement episodes, and when I say debasement, that means a devaluation in the purchasing power of a currency, they tend to be somewhere between 20 and 50%. But let's take an extreme example of 30 or 40%. If that were to occur, there would be a rush to store of value assets. And in the traditional world, that would be gold. And I think that there is a case that can be made that gold would have to go up by 3 or 4 or 5 times in order to satisfy that demand. And you saw that those probability distributions that Mike showed about the price of gold from Incrementum. And so in my mind, if you had roughly a 7 to 10% weighting in precious metals with that geared towards gold, and a monetary debasement scenario ended up happening, that would help offset the risk of that loss in purchasing power. Now for Bitcoin, that number is much lower because it has much more asymmetry. that slide that Mike showed with Bitcoin just being about 10% of the total gold market means that if there is a debasement scenario where Bitcoin is the store of value choice, not gold, and the gold market would need to go up 3 times. So let's say it's at 30 trillion and today Bitcoin's at 1 trillion. Well, that means that the Bitcoin would need to go up 30 times in order to have that same level of total market cap to satisfy the demand. So in those terms, you'd only need 1%, 1.5% in order to offset that risk. Now, so I think a 2% position is totally rational. If it went to 0, you're not going to be that negatively impacted by it. But if it goes up 10 or 15 or 20 times because you need it, you'll be really disappointed if you don't have it.
Excellent. Let's see, municipal bond funds have been touted as a safe way to get tax-free income in retirement. With expected increases in inflation, does that strategy hold?
I'll hop in here. Clearly the information was presented here. The reason we've entitled this presentation as we did is because the times they are a-changing. And as we spent most of the last 2 or 3 decades realizing that tax-free bonds paid a somewhat lower rate of return than other things, but still a decent rate of return, the answer is that they pay a remarkably low rate like everything else. And in the form of a bond fund, there is some risk to your principal if inflation comes back and interest rates go up. So buying a bond fund at a low point historically in the interest rate cycle is probably not the best risk return trade-off.
Yeah. But the conundrum is you can't, let's say you had a 50-50 stock bond portfolio, you can't simply take all that money and put it into stocks because of the risk characteristics that would ensue. And one of the most important things when you're a retiree is the sequence of returns of your portfolio and how much you're taking out in terms of a distribution. So you have to think through these things, really deeply to determine what the right mix of holding some form of fixed income is with the other things we talked about, like commodities, like gold, and so on and so forth. Over the past year, well, really, it was sort of right around COVID, pre-COVID, and after COVID hit, we were already in the process of moving a portion of our clients' fixed income into gold. About 10% of the fixed income that they would normally have had been transitioned into precious metals. We're doing the same to a smaller degree with commodities, and we did that a little bit with Bitcoin as well. So it's a tricky situation because if you look at bonds in isolation, they don't look like a very good investment, especially with inflation factored in. But in the portfolio context, they still potentially provide a very meaningful role in risk management that is important, especially when you're in the distribution phase of your portfolio.
Excellent, thank you. How concerned are you with China having more influence on the world?
Well,
we both probably have different opinions on this, or we have slightly different opinions potentially, but it is a fact. China's influence is growing, and we can't go backwards. And it's clear that they are not as capitalist as we previously thought, and they clearly are still a very top-down and command and control sort of political system. We're going to have to find a way to deal with them. But what we have seen in this last year or so, as COVID has impacted everything, and as the trade difficulties under President Trump and now under President Biden have continued, that many manufacturing companies are beginning to shift their supply chain out of China. They're looking to diversify their supply chains more and more if they haven't already. And as Adam pointed out, China is not really the cheapest place to make a lot of things anymore. So China itself is in a bit of a transition, and how the world reacts to and deals with China is still a very big open question. But we look at it as still the second largest economy in the world. There are a number of very strong growth opportunities there, and we're going to consider those. But we're also going to consider these other factors, as we mentioned, such as the freedom scores and all the other things, because at the end of the day, freedom often makes a difference in how well an economy performs.
Yeah, I largely agree with that. I think that China certainly has its own internal issues with its leverage and debt situation, but they're clearly going down the path of trying to be a regional power and take some of the dollar's dominance out of the system. They're by far of the developed nations further down the path of creating a central bank digital currency that could have really profound impacts on the globe. So the US has some catch up to do in certain areas, and China is always catching up to us in other areas. I don't think that we're headed for an actual tactile war, but the technological Cold War will continue, and China is going to be investing a lot of money to try and catch up in that space. So there are opportunities to take advantage of within that construct.
What about our dollar?
Well, the dollar is a tricky question because when we're talking about inflation and debasement, what we're really talking about is relative to goods and services. If every country in the world is also going down the same debt binge and spending money they don't have, then the dollar may not actually fall. It could actually increase versus other currencies, especially if there's a global, crisis again. The dollar tends to do pretty well. So we've always had the opinion that the dollar would decrease in value as global growth improved and the global system becomes less reliant on the dollar. But when we say that there is the risk of a currency debasement situation, that's really not as relevant relative to other currencies because everyone's doing the same thing. It's more relative to just the general cost of goods. Now, if you had a major move in the dollar in either direction, that could be quite significant. But in general, we don't necessarily think that the dollar is going to move that much unless there's some form of rapid acceleration in the growth outlook for the world, or if we devolve into another crisis.
A couple people wondering where the cocktails and snacks are, but we'll address that.
Next time we'll do it.
In-person briefing.
The next private briefing will be at 8 in the morning, so we don't have to field that question.
I don't know. Some people may still want that at 8 in the morning.
Maybe. Any thoughts on where you expect the real estate market to go in the next year or two?
Oh, goodness. Well, as the realtors are fond of saying, all markets are different, but at the end of the day, it is one of the significant classes of risk assets. And if you see continued long-term commitment to low interest rates by the Fed, which seems to be the case, and if you see the demographic shift of millennials continuing to do something called household formation, which is getting married and wanting their own homes, and you consider other things like the underbuilding of the housing stock that we've done since the financial crisis a decade or more ago, there are a number of tailwinds behind the housing market. Now, a lot of things can disrupt that, but in general terms, the housing market doesn't have to suffer a dramatic downturn because those forces could be supporting it to some degree.
It's not the same structure as we saw going into the 2006, 7, 8 debacle. Leverage is not as prevalent, especially on the consumer balance sheet. A lot of homes are owned by hedge funds, and we can get into the politics of that at a different time. But in general, people are looking for scarcity right now. They're looking for scarcity in assets, and real estate is scarce. So unless interest rates move higher in a meaningful way, real estate prices probably are not set to fall very significantly.
We'll do one more question to be respectful of everybody's time, and then we'll close it up. From one of our dear clients, she's noticed a little less than usual buy and sell activity this past year. Is that the case? And why, if that's so?
Well, it ebbs and flows based on market conditions. Last year was a unique year where we had to have a lot of movement to get to where we wanted to go. The year before that, we were positioning for some of these themes that we're talking about today. We don't view it in terms of how many trades we're making. We view it in terms of what needs to be done in order to get the portfolios into the area that they need to be. And in general, we try to have fairly low turnover. We like to buy investment themes and let them play out over many years. That's more tax efficient, and we find that it works better that way. Sometimes you're forced to make moves when things are changing more rapidly. But I think this year is more representative of how we prefer to operate than what we've seen over the past couple of years.
Perfect. Thank you. Again, thank you all for joining us. If you have any other questions, please feel free to reach out to any one of us. You all have my email address now. Happy to field those. But again, I appreciate the time you spent with us today, and have a great afternoon.